why does it take so long for ideas to develop? I mentioned insurance. It goes back to ancient Rome. Why is it that we didn't have any real insurance? I mean, in the sense of an insurance company with actuarial tables and the like, until the 1600s. And why did fire insurance on homes become important? They didn't even become, most people didn't own fire insurance until after the reformations in the Great Depression. So the funny thing about invention to me is that ideas that seem simple and natural somehow don't get established. I'll give you some examples. These are from my book, New Financial Order. Wheeled toys, okay. Well, archaeologists in Mexico find that there were children's toys that had wheels on them, like little toy cars, and you could roll them along the floor, all right? So they knew about wheels. But you know what? Nowhere in the Americas did they ever find a wheeled wagon or anything used, a wheelbarrow, nothing. They only had toys. Strange. Now this brings up another example of wheeled suitcases. And so I wrote this book in 2003, 13 years ago, and you believe you have a suitcase with wheels on it, right? Okay. Does anyone not have wheels on their suitcase? Well, it seems like this is so obvious. Suitcases should have wheels. But they didn't until 1972. That's not long ago. And in fact, I was doing research for my book, and I had an undergraduate research assistant. And I was intrigued by these wheeled suitcases. So I asked my student, go find the inventor. See, is he still alive? So he tracked him down. It was Bernard Sadow in 1972, and called him up on the phone. Again, inventors don't tend to be famous. You didn't know this name, right? It's changed your life. You don't know what it's like carrying a heavy suitcase when there are no wheels on it. So my student asked him, what was it like inventing the wheeled suitcase? And he said, I had a lot of resistance. I showed my wheeled suitcases. I went to department stores. Remember department stores? They used to have those instead of online shopping. And I told them, this is a great idea. And they said, no, it isn't. Nobody's going to buy that. It looks ridiculous, wheels on suitcases. They said, look, if you want help with your luggage, every train station, every hotel has porters who will be ready to help you. You don't need these things. That's what they told him. But he did get some of them to sell. The problem with his wheeled suitcase, however, he didn't get it right either. He had a suitcase, a big suitcase like this, and there were 4 little tiny wheels on the bottom, and there was a strap, right? So you would pull on the strap, like a leather strap, and it would trail behind you. The problem, have you ever seen that? You might still have one in your parents' attic, okay? They flop over, that's the problem. You start pulling and it falls over sideways. But you can do it. You can figure out eventually how to pull it. It wasn't until Robert Plath in 1991 invented something he called the rollerboard, which you now have, right? And actually it improved again. But in 1991, he had a suitcase with just 2 wheels on the bottom and a rigid handle, not this leather strap. And the handle collapsed into the suitcase, and you could pull it out, and then it would tilt, and it would go behind, but it'd be very stable. That was 1991, and that just completely took over. He called it a rollerboard because he was an airline pilot, and he thought he made it narrow enough so that you could roll the suitcase down the aisle of the airplane, and it wouldn't bump into anyone. It was under control. Do you know what the latest thing is? It's like a rollerboard. I'm going on too long about this. The latest thing is now they have 4 wheels again, and you can either do it like a rollerboard or you can stand it up, and people like that. So but it took, every one of these inventions took 10 years, and you'd think Bernard Sadow would have figured the whole thing out in 91, but that's not the way it works. Oh, and movie subtitles were invented in 1920. But never really used in silent movie. I think this is amazing. They had this whole silent movie era. They'd already invented subtitles, and they didn't put them on movies. They had these intertitles. You remember silent movies? They would stop the whole movie, and they'd show you this intertitle. But it's so much better, and I'm really used to it now. You can watch a movie with it doesn't matter what language it's in anymore. So obvious. Oh, and desks over exercise bikes. I have this in my basement. I put a desk over my exercise bike, and I'm preparing my lecture. Mayo Clinic is selling them now, but it's a slow thing. Eventually, you ought to get one so that you can exercise and do scholarly work at the same time. I think that we're moving ahead. Another way of putting it is financial theory and practice are good areas for young people to go into, because I think it has been transforming and will continue to be transforming. And I think that the nature of our financial markets in 10, 20, 30, 50 years, which matters for young people today, will be amazingly different and better. And you have to join the financial community to make that happen. Mm-hmm. You don't have to. I'm just saying.
Do you have in your mind an ideal of what that future looks like?
See, there were people who proposed, like Karl Marx, for example, right. Or Robert Owen, who's the guy who coined the term socialism. They had ideals which they sold on the public as simple and obvious. Right. But I think it's not quite so simple and obvious. The human species is the product of evolution that gave us a number of different mental quirks that served us well as cavemen, but now they don't really fit into the modern world, and we're just seeing new opportunities. So we might be excessively fearful or unwilling to change. We might be too focused on our own personal lives, and we have to invent something different. And it won't be a perfect world, just like it's never been a perfect world. But it's exciting, and it's getting better.
What do you think has been important about the innovation of people's ability to insure against risk in the marketplace, whether it's through just something as simple as an insurance contract or by other means?
Well, the history of risk management goes back thousands of years. I would say that the history of risk management is the technology that we have has been very slow to develop over the centuries. And that encourages me to think that it has a lot more to develop yet. I think that there's an inherent conservatism and mistrust of new financial arrangements, and a sense that I'm not coming to this party unless the in people are coming to it also. And so things are very slow to develop. I don't know if I'm answering your question. But it is a belief of mine that financial innovation is a pillar of our civilization, that it's not just shifting papers around and getting people to sign documents that trick them into signing away something. It's a sequence of inventions that incentivize people, provide capital for enterprises, create organizations that last through time, that separate themselves from the objectives of the individuals who comprise the corporation, and get people focused on some common good that will be produced.
Do you think it's safe to say that historically financial innovation has occurred on the, kind of the upside, looking to capture new markets and new ways of earning returns, versus on the kind of the downside risk management side of the ledger?
Well, when we say risk management, it seems to imply a focus on the downside. But it's on the upside as well, because people accept the downside risk because there's something on the plus side that is enticing and is exciting. So people seem to, this is an interesting point, people seem to like gambles that involve a small amount of money lost with high probability and a large money gained with low probability. So if that's what people like, we have to try to turn the natural risks, which might be balanced equally, into loss and gain, into something more appealing. So that's one thing that limited liability did. People like lottery tickets. I pay $2 today, and I have the chance of winning $10 million. For some reason, the chance is minuscule. It's virtually zero. But somehow people like that. So that's a discovery about human nature. Why they like that is a puzzle, but we just know that people like that. It's because people savor the small probability. They think, I have this lottery ticket I bought this morning. I could be worth $10 million at the end of the day when they announce the number. That just makes your day bright. And then when you don't win, you still feel, well, it was just $2, so what? So what limited liability does is it creates that for corporate invest. Same sense for investing in stock. You just put in, you bought 100 shares, so maybe that's $3,000. That's a little bit more than a lottery ticket. But hey, I could be a multi-millionaire if I bought the right company. It's like a lottery ticket. So people flock to these things. And they're disappointed almost always, but they're not disappointed because we end up with a more vital business sector where things are created. So we have to try to reframe things. That's what part of financial innovation is. Reframe risks so that they're appealing. And we want it also, for good social purpose, to be risks that need to be taken so that they benefit the economy. So I wanted to give some examples, both from the past and from the things that are talked about now. So the first example I like is limited liability. I'm going to credit New York State with inventing the full dimension of this idea in 1811. However, it precedes, the idea of limited liability precedes 1811. And I don't know what country can be given credit for discovering it. But here's the idea. Well, actually, it goes back in a way to bottomry, which I talked about. The idea is that investors, in order to be encouraged to invest in businesses, should have protection against liability for what the managers of the business do. They should have limited liability. So the example we gave before is if you're in ancient Rome and you are considering investing in a trade, a trip where they're going to send out a ship to trade goods, if the ship sinks, you are not liable. You don't have to pay the loan back. That's an example. But it was never enunciated as clearly as in 1811. So New York State passed a new law then that said investors in stocks can never be pursued for the mistakes of the company invested in. So what we're going to do is allow it, well, already they had shares. You could buy shares in businesses. But you only are liable for what you put in initially, and no more worries. But before this law, there was doubt about that. Apparently, the idea of going after shareholders for the sins of a company was rare, but people had to worry about it. So this is what could happen before 1811 in New York. You could buy shares in some company, and then the company commits a crime, and then they come after you to pay up for the crimes of the managers. And you say, I didn't know. I just bought some share. I didn't know who these guys were. And they would say, what? Tough luck. Pay up or go to debtor's prison. That's what they would potentially do. And they had debtor's prison. There was a different idea then about The idea is, if you invested in this company, you are responsible, and we're not going to forgive you. So when New York State passed the law, there was a lot of controversy, and a lot of people in other states said, this is crazy. People are not responsible for what they invest in and what happens. This is going to lead to wild transgression of our laws and our Massachusetts passed a law similarly around the same time, reaffirming that shareholders are responsible for what they invest in. You are a party to the crime. So what happened? Well, almost all the business went to New York, and New York became a mecca for business. And eventually, gradually, state by state, they all did it. They all passed limited liability laws. There were a few spectacular failures, corrupt businesses, but so many good businesses started this way. So I think this was an invention, and it was an experiment in human nature. The idea that the problem is that people, if you are responsible for everything you get involved in, then you won't do it. You won't supply capital to some business. David Moss was a graduate, I mentioned him before, a graduate student here at Yale who wrote his dissertation and then a book called When All Else Fails, The Role of Government in Risk Management. He describes the controversy in 1811. But the real genius of limited liability is that it makes it possible for you to make an investment in some enterprise, and then it's just fun thereafter. No more work. Or you could lose what you put in, but you know exactly what you put in. So what Moss said in his book is that it's really behavioral. No, this is human factors engineering. Nobody knew when they tried limited liability what would happen. It might encourage corruption. It might not affect the supply of capital. But we discovered that investor psychology favors limited liability. That's because investors tend to, if they're not limited liability, they overestimate the minuscule probability of loss. Just as when they buy lottery tickets, they overestimate the minimal probability of winning. So he thought that what the limited liability did is created a sort of lottery effect. People are basically, you're driven toward fun things, and you don't like things that make you worry. So let's make it. Buying a share in some startup company is like buying a lottery ticket. And you probably won't get rich. Almost certainly you won't get rich. But hey, it's fun. And so just like lotteries, I don't know why people, when I go to the train station, I have to stand in line at the little store there behind people buying lottery tickets. I can't imagine why anyone would buy those, because your chance of winning is so low. But people do buy them. It makes their day. I guess they have fun. You buy a lottery ticket in the morning, and then what do you turn on television? I don't know. There's some television clip that shows you them drawing the ball, and you're all excited and you're having fun, and you lose. You'd think they keep losing, that they would stop, but they don't. There's something, you wouldn't know this, but that's human nature. The other thing about limited liability is that it created the whole idea of holding a diversified portfolio. If you don't have limited liability, absolutely not. You should not hold a diversified portfolio, especially if you have some wealth. They'll go after you. One of those companies is going to go down, and they'll go after you. So don't hold a diversified portfolio. Once they discovered that, once they did limited liability, then you could start enjoying your investment and diversify over many things. And we know that there's power, risk management power in diversification. So I'll give you another example of practical financial innovation. So it's here, inflation index debt. So we have always traditionally borrowed money in debt contracts and promised to pay them back in the currency. But there are so many examples where the currency is unstable, especially if the government prints it. they make big mistakes. So the idea is, why don't we have a price index and have a debt contract that pays back indexed to inflation? Then it's fixed in real terms. What could be more obvious? But the history of it is very shows it was very slow to get going. I've tried to find who was the first person to define debt in terms of a consumer price index. Now, there were earlier examples. For example, in Japan, they had rice bonds, and maybe other places too. So a rice bond was a debt instrument that was payable in rice, yes, the grain, instead of currency. And you're safer with that than in currency if the government might print money and debase the currency. But the idea that I'm referring to is something broader. The problem with rice bonds is the price of rice isn't stable relative to other prices. So you really want an index of prices. You want to tie the contract to an index. So as far as I've been able to tell, I wrote a paper about this. The first index debt was invented here in the United States in 1780. And it occurred because of inflation. The US government was giving debt to the soldiers. I don't know if this was during the Revolutionary War, denominated in currency that was issued then by state governments. And they debased the currency because of the war. There was rapid inflation. And the soldiers were really unhappy because what they got was already worthless before they got it. And in order to keep the soldiers happy, this was necessity. As Plato said, necessity is the mother of invention. He was quoting someone else, I believe, but that's where it appears. So they decided to define a consumer price index. They didn't call it that, they just defined it. And the bond had to pay out in inflation index terms. What a wonderful idea, simple. You should promise them in real terms, not in money terms, or in inflation. But there was a lot of other people were paid in nominal debts, and there was an actual rebellion called Shays' Rebellion about the unfairness of this debt. So somehow the US government didn't issue them again. The index bonds in 1780 were issued by Massachusetts, but no state issued index bonds again until 1997. I can't believe that it took so long. I was there advocating. This is one thing I advocated before it happened. Not that that necessarily made a difference, but I just wonder about it. It seemed impossible. I called Treasury like in 1996, and I said, I want to talk to someone here. Why don't you do index debt, inflation index debt? And I got a guy on the phone, and he said, oh, we've thought of that. We have a joke here at Treasury, and that is that if we ever do issue inflation index debt in the United States, we should send the prospectuses to the members of the American Economic Association, because they're the only ones who would be interested. I said, how can that be? I mean, people are getting their real value of their debt wiped out by inflation. Don't they care? I mean, and it still puzzles me that it isn't more important. People just don't get it. They make the same mistake again and again. They think, well, inflation is only 2%. But they don't know that history shows that governments mess up all the time. Now, of course, this is America. We don't mess up here. I guess you could say it's patriotic feeling. You don't want to raise the possibility that we would mess up and have a lot of inflation. But maybe even if it isn't a lot, maybe, how about 4% a year inflation? And you lose half your money in 20-some years. That's within the realm of possibility. People don't even think about it. But we do have inflation index debt in the United States. And it has spread around the world. Now, the US was not the beginning of inflation index debt in 1997. It was in 1780, I believe. So here's an invention that I've been extolling now for 25 years. So far to no, well, I shouldn't say no success. I've gotten attention for it. But I think, you know, it won't happen in my lifetime, but we'll do the, we'll do the unidad de fomento eventually. It's coming. So let me tell you the invention. In 1967, Chile was going through a hyperinflation. I mean, prices were just going up. I don't know what it was, 1,000% a year or something like that. And people were distressed by it. When you got your paycheck, you know what you did? You got your paycheck. Of course you cash it immediately, and you run to the store and you spend the whole thing, because by the end of the month, it won't be worth anything. So this is crazy. So now the idea that Chile invented then was to create a new unit of account, and in Spanish, unidad de fomento, which means unit of development. I don't know why they called it that, but I can think of a better name, but that's what they called it in 1967. And what it is, now money has several functions. It's a store of value and a unit of account. You can, and a means of transactions. You can separate out those functions. You can have a separate unit of account that is not money. So they invented something called the UF, Unidad de Fomento, and they allowed its value to be tied to the consumer price index. Back then, they would publish in Chilean newspapers every day the exchange rate between the escudo, which was the currency they had then, and the peso, which is the, and the US, and the UF. So I looked it up today. Now it's a website. It used to be in the newspaper. Well, maybe it's still in the newspapers, but there's a website, valoruf.cl. I looked it up this morning, and one UF is 25,655.55 pesos. Now you might wonder, why did they pick such a big number? They didn't. They picked some small, maybe it was 1-to-1 in, I don't know exactly, in 1967. But they've had so much inflation in their peso that it's up to 25,000 pesos per one UF. And that is worth, at the current exchange rate between peso and dollar, $35.92. So there's been a huge increase in, even though Chile has gotten its inflation more under control, the price level has still increased 50-fold, over 50-fold since 1977. So, but you know, it's not, the US is not the haven of price stability either. Would you believe it? Prices in the US have gone up 24-fold since 1913. That's not exactly a zero inflation environment. And if you're saving for your retirement, for example, your grandmother buys you a saving bond that matures in 2050, you should be worried, right? What is that going to be worth? So Chile had the escudo currency, and between 1960 and 1975, they had so much inflation that they had to replace it with one escudo to 1,000 pesos. But then the peso then eroded away, and they had to define a new peso, which was 1,000 old pesos. So we have something like a 50 million-fold increase in prices in Chile. So why would anybody still quote prices in pesos? I don't know. There's something about human psychology. But at least let's give credit. The Chileans are the most advanced country in the world in terms of dealing with inflation. When I was in Chile, I was giving a talk at the central bank, and I said, whose idea was this? This is amazing. The whole world should be following Chile. And then you know what? Nobody knew whose idea it was. Nobody. They think it's a national embarrassment because it reveals how much inflation they've had. I said, no, you are the world's leader. Then the world ought to copy you. Eventually they will. Finally, real estate risk management devices. Values of homes go up and down a lot. And people are not protected against these fluctuations. And this is bizarre to me. We have home insurance, casualty insurance, that protects you against accidents in your home, or you get protection against fires. But why not protection against the big risk, which is the change in value of your home? Are people who do things like short the financial markets good people or bad people? Shorting, is it evil to short a market? Well, if you're shorting a market for homes in your own city, you're just trying to protect yourself against a collapse. It's not so evil. If you're doing it to make billions of dollars, it's a little bit ambiguous, your moral stance. But anyway, it's legal. You can short markets. And I thought it would be a good thing if people could short the housing market. It would help stop bubbles, and it would help people protect themselves against them. They could also be a source of risk management for equity-protected mortgages. You should have a mortgage that tells you, when you buy a house, if your home price falls below the amount you owe, we'll correct your debt downward. Isn't that sensible? But that's not what we did, not what we are doing. If you buy a house for $500,000, you borrow $450,000, the price of the house falls to $400,000, you are now $50,000 underwater. You go into your mortgage lender and you say, I'm underwater, what do we do? And the mortgage lender will typically say, tough luck. We'll sue you, we'll go after you if you don't pay. Why do we leave it like that? Well, it's because progress is slow.
So you talk a lot about financial innovations. Is there anything of recent that is really exciting for you, or that you think is kind of the next frontier of finance?
There are many innovations. I don't know where to begin. But let me put it this way, that most of our risks are still not managed well. For example, your home price risk. That is borne by you, the homeowner. And I actually worked with the Chicago Mercantile Exchange, and we do have a futures market for and an options market for single-family homes, so that you could buy a put option on your house to protect you against a big fall. That is up and running. I want to see it grow and get more active, but it does exist. Another risk, which is even bigger, is the risk of your human capital that you are investing in now as a student. And now you are an MBA student, so you have chosen a very fungible form of human capital management. That has to be a very versatile skill that, at least that sounds like it to me, that won't be replaced by a computer. Now, it might be partly replaced by computers. In fact, it already has partly been replaced, I think. But I think that's, but the question is, what if you pick a human capital that is more focused, like nuclear engineering? You could, how can you protect yourself against that risk to your human capital? Well, I have an idea how you could do it. You could short the stock of a nuclear power company and assume that it's going to correlate negatively with your risk. So you can sort of do it. But I think there are other things that might be more appropriate for most people. I think that's kind of requires some sophistication to pick a company and short it to protect yourself, your own human capital. President Obama, in his State of the Union address for 2016, proposed wage insurance, that when people lose their job and switch to a permanent job with a lower wage, there should be some payout that would, insurance payout for the loss of livelihood. I've advocated things like that too in my writings. I call it livelihood insurance. But I can keep coming up with, there's so many innovations. We don't know which one. What we do know is that risk is not well managed worldwide. And we also know that enterprises are not functioning well everywhere. That there are many places in the world where free enterprise and entrepreneurship seems limited. So there's a lot of things to be innovated. So today I want to talk about the efficient markets hypothesis, the history of the hypothesis, reasons to think that markets are efficient, and reasons to doubt it. Let me start with the dinner experiment on Friday. So we had a nice dinner at Berkeley College, and as an experiment, those of you who were there will know my experiment. I passed out slips of paper with this chart. So the chart shows the Standard & Poor 500 from 1950 until a couple days ago, where it was, there it is, that's the stock market. And then I left room on the right out to the year 2050. And I asked each of you independently, and I asked you not to look at each other when you did this, to pencil in a forecast for the stock market from 2016 to 2050. So I'll just give you a couple examples that you filled in. This person is forecasting, what does that look like? Another 20% drop in the market, then a correction, and then a drop, and then another boom, and then another crash, and another boom. So I think I picked this one out as just typical of what was seen. I should have shown you more. I only have one other here. This is another one. So you are a very pessimistic bunch. What would the efficient markets theory say should be the forecast? There are one or two of you actually did that, or maybe it was three, so more or less. If markets are completely unforecastable, what should it be? Well, one interpretation of efficient market, your forecast should have been zoom straight across. It's not going to leave where, I mean, the central tendency is tomorrow's price is the same as today's price. Because I can't forecast changes up or down, who knows? That would be efficient markets. But there's another version of efficient markets, and some of you actually did this, but not many of you. That your forecast would be not straight across, but perfectly growing exponentially along an exponential growth path. That would be the efficient markets hypothesis, taking account of the fact that there's a growth. It's not a random walk, but it's a random walk with growth. But almost none of you did that. Maybe my instructions weren't clear enough. But what you're doing is showing plausible paths for the stock market rather than the expected path. That's how people seem to interpret when I say, please forecast it. You're trying to show what's plausible. So you're making, if you look at the recent history, this person made it look like the recent history, right? But this is not, unless you can tell me, I don't know who did this forecast, but unless you can tell me, why did you have a turning point here in, what year is that? 2020? Why did you have this turning point? Why did you have this turning point? Where you put it? They have no reason. This looked plausible to them, so they called that a forecast. I know you might have done better if you had more time to think about it. But I think this gets back to, it's related to a concept in behavioral economics that Kahneman and Tversky talked about. Those are two psychologists, called the representativeness heuristic. People don't behave like forecasters. They think that something they saw in the past is representative of what will happen in the future. Now, I'm not defining their theory exactly, but I think this is how most people take it when they have to give a forecast. The random walk theory is a theory, first the term was coined by statistician Carl Pearson in the scientific journal Nature in 1905. And he said a random walk is a process that changes in such a way that each change is independent of previous changes and totally unforecastable. It has become popular lore to think of a random walk as the walk of a drunk at a lamppost. Okay, and this toy right here is a mock-up that someone once made and sold. If you want that, I found it on the web. You can buy it. It's amazing what you can buy today. But there's your drunk. Now, if the drunk is so totally drunk that every step is completely random, your job, according to Pearson, is to forecast the position of the drunk in 10 minutes, in 20 minutes, in 30 minutes, okay? So what is your forecast? Well, what do you think? What would be Carl Pearson's forecast? Well, the forecast is he's going to be right at the lamppost. You'd never, and the reason you make that as your forecast is you have no idea whether it's to the right or to the left or whatever. The direction is random. So he's probably not going to be at the lamppost, but since you can't predict which way, you might as well predict at the lamppost. That's why I was saying on the previous slide that your forecast should have, well, I'll go back here. Your forecast should have been zoom straight across if stocks are pure random walk. But that's not what you did. In 1973, Burton Malkiel, who was a professor at Princeton and I guess still is, he came to Yale for some years as dean of the Yale School of Management. But he wrote a best-selling book in 1973 called A Random Walk Down Wall Street, arguing that, well, it wasn't original in the book. This was a popularization. But it's a bestseller, and it sold millions of copies. The idea was coming out then that stock market prices are really random walks. It's all an illusion that you think you can forecast it. So you shouldn't try to forecast it. You should just hold a diversified portfolio. And that became conventional wisdom starting around that time. Burton Malkiel was his book was very well timed and a very appropriate title. The funny thing about Malkiel's book, though, is that he didn't really believe the efficient markets hypothesis that he made the title of his book. Because if you look at the last chapter of the book, he had investing advice. And he told you to do various things that were, I thought, inconsistent with random walk hypothesis. And I finally met him at a cocktail party. And I asked him, I said, you know, some of your investment advice doesn't quite fit with random walk. And then he said, well, I know. I can't quote him exactly. He said, I can't get these other kinds of thinking completely out of my mind, something like that. So it's like psychologically, we're not attuned to understand a random walk. Now, another alternative to a random walk has the property x sub t, if x is the random walk at time t, is equal to its previous value plus noise, epsilon sub t. And the noise is totally unforecastable. An alternative to a random walk model is a first-order autoregressive model, an AR1 model. In this case, 100 represents the lamppost. It's the starting point. And then x sub t, the value of the position at time t, is equal to the starting point plus rho, where rho is between -1 and +1, usually positive, times x sub t minus 1 minus 100. So what this is a model which is modifying the drunk at the lamppost a little bit. He now has a piece of elastic wrapped around his ankle, and the elastic is tied to the lamppost. So if he starts walking away from the lamppost in any direction, he gets tugged a little bit back to it. And the further away he goes, the more he's tugged back. So in this case, this is the x sub t minus 1 minus 100 is how far he is from the lamppost. And if rho is some high value, then that means there isn't much of a tug. It's a weak piece of elastic. So he can go wandering off, but eventually he's going to come back. So this is mean reverting. It's reverting back to the lamppost. Now the question is, there were a lot of studies suggesting that the stock market is a random walk. But how do we know whether it's really a random walk or it's an AR1? Maybe when the stock market gets really high, it's going to go back, but not right away, but eventually. There's something tugging it back to a normal level. And when it gets really low, it's going to go back up. The problem is that it's hard to tell a distinction if rho is close to 1. If rho equals 1, you can see these hundreds drop out, and it's just a random walk. But if rho is lower than 1, but not a whole lot lower than 1, then you really can't tell whether it's a random walk or not. So this is an example of a realization of a random walk, the blue line, and an AR1 with rho equals 0.9. And I defy you to tell me which one of those is well, you can tell in comparison. This one had started not at 100 but at 1. So you can see that there is some the AR1 has come closer, that's the red line, has come closer back to the starting point. The random walk has no tendency to come back to the starting point. So if stock prices are an AR1, then it means you should stay out of the market when the price is too high and go back in when the price is too low, which is different advice than random walk theory.
Many would argue that when you're forecasting the future, whether economists or people in finance who are working in Wall Street, for instance, are forecasting what the future of a market is going to look like, to look at what's happened in recent history and try to project it forward, and using a rational logic model to try to project into the future. But of course, you talk a lot about sort of the irrational nature of the market and how we're behavioral, or how we're irrational beings. But what I'm curious is, how do you build in risk management to factor into sort of the irrational nature of the markets, and to capture sort of some of that irrational exuberance that you talk about and the bubbles that might arise in such things as housing markets?
Well, a deep question. How do we handle? Why do we have irrational exuberance at some times and not other times? And what can we do about that? Our principal tool that's talked about is central bank policy. And central banks, when they think that the market is becoming overpriced, can tighten credit. And alternatively, when they think it's underpriced, they can loosen credit. That is a tool that is being used, although central banks don't seem too enthusiastic about trying to stabilize financial markets. It does seem to influence their decision making. But that doesn't get at the basic psychology very much. So the problem is people are looking at price of a speculative asset as something completely separate from the business, or largely separate from the underlying business that is paying the bills, paying the dividends. They seem to often be looking at the psychology of the market. They're looking at trends of technical analysis, and they become unfocused on the real fundamental, which you might think ought to determine the long-run value of an investment. They're focused too much on the short term, predicting what it will do in the next month or so between the time I buy and sell. So there have been proposals that might reduce that short-term speculative component. So one idea is to put a transactions tax on securities trade, so that would force people to be, or encourage them to be longer term in their investment. We have a distinct, so we have, but in limited. We also have a capital gains tax that distinguishes between short-term and long-term capital gains. And a reason to do that is to discourage people from being short-term holders. They'll end up paying a capital gain tax on the profit. And there's other longer-term proposals. Michael Brennan at UCLA proposed that we should create separate markets for corporate dividends at various horizons, so that you are focused on a dividend at some date in the future in making an investment. He thought that would focus people's thinking on the fundamental. Well, now we do have markets for claims on dividends. I don't know, it hasn't had any major impact. The problem is here that human psychology is not easily managed. Talk to a psychiatrist and you'll hear that. We have antidepressant drugs, but you know, they don't, we have antipsychotic drugs. They help, but they don't cure in a routine way. The same thing is true for anything you might think of that might deal with irrational exuberance in the markets. I wish we had lithium, which is what they use for irrational exuberance in bipolar disorder, but it's not functioning in the stock market.
Sure.
So let me just talk about what, I'm going to give you a history of thought sort of about market efficiency and what people have thought over the time. Starting in the 19th century, information technology began to develop. There was a man named Reuter who, just before the invention of the telegraph, decided that stock markets need up-to-date information. And so he thought, how can I get information fast? I'll sell information. So what he did is he said, these pigeons fly faster than any human transport, you know, carrier pigeons. So what he did is he set up offices in major European cities and bought pigeons. And as soon as some market event happened in London, he would tie a piece of paper to the leg of the pigeon in London, and send the news to Paris. And how long does it take a pigeon to fly from London to Paris? I don't know.
It takes 4 to 6 hours for a pigeon to fly from London to Paris.
So it gave a trading advantage to people. So he was a big success with his pigeon service. And later, when they invented the telegraph, that was here in New Haven, by the way. Samuel F.B. Morse invented the telegraph. What year was that? Wasn't it around 1840? I don't remember exactly. Reuters went to the telegraph to speed it up even more. By the late 19th century, everyone was getting information with the speed of electricity. And they got beepers in the 20th century installed that would beep them when there was some important news. They would carry that around. Even before you had a cell phone, you could get a beeper. So the idea is that the information, there's so many smart people trying to get information that it must be hard to beat the market. And that means that you really can't predict it. So the random walk became plausible because people thought, yeah, all these people are trying so hard to get the information as quickly as they can, and they trade on it as soon as they get it. So doesn't that mean that if anyone has some idea that the market, so if the market goes down in London, it will probably go down in Paris too. So if the London market falls, you would like to sell in Paris. The problem is you can't get the information in Paris fast enough. But now that they get it really fast, the market must adjust almost immediately. So this is what it came to. The reason efficient market sounds plausible is you have to educate people out of naive ideas that they can predict the market. So some people will go to their broker and say, you know, the other day I read in the Wall Street Journal that this company has a new drug that's about to come out. So is that a reason for me to buy? Then the broker will tell you, you read it when? Last week? He said, well, your broker might say, when that news came out, I remember my beeper went off immediately, and I rushed to my colleagues and said, what's this news mean? And someone said, sell right now. And so I placed an order in 15 seconds. He said, you got to beat the others. And then I said, I just sold, but I hadn't even had 15 seconds to talk about it. They talk more about it, and they think, well, maybe I shouldn't have sold. So 30 seconds later, you buy. And then within 2 minutes, they've gotten expert advice on what it means. And the market has gone wild, and now it settles down at the new optimal level. So maybe the market wasn't perfectly efficient for 15 seconds. But you had better be educated that if you read something in the newspaper last week it's already incorporated into market prices. Even in 1889, although they didn't have beepers then. Here's a 1904 article. It's a really nice article by Charles Conant in a magazine. And it's about the beauty of markets. And he was referring to the public, he referred to an ignorant public view that markets are a sort of gambling casino. But he said a moment's reflection should convince such person that a function which occupies so important a place in the mechanism of modern business must be a useful and necessary part of the economy. Yeah, what he's getting at is that those prices in markets are the result of people trying to figure out values. And if we didn't have the markets, we wouldn't know what anything was worth. Any business plan involves prices. As a business, you're going to have to buy commodities, or you're going to have to borrow at interest rate. All these prices are relevant to an intelligent decision. So not only are markets efficient, according to Conant, they're better knowledge than any individual because it involves so many people all putting their money on the line and trading on it. And then it produces values, which he implicitly assumes in 1904 are the best estimate of fundamental value. And then it drives businesses. Businesses then make decisions for whether to build a new factory or to hire new people based on these prices. So it's a beautiful system that he talks about. Until the financial crisis, textbooks were glowing in defense of the financial market. Even your textbook, Fabosi, in an earlier edition in 2002, said publicly available relevant information will lead to correct pricing of freely traded securities in properly functioning markets. Here's another textbook of finance by Richard Brealey and Stuart Myers. And in an earlier edition, efficient markets really took hold, the theory, in people's thinking, starting after Burton Malkiel's book. It really was an intellectual revolution. But according to Brealey, Myers, and Allen, security prices accurately reflect available information and respond rapidly to new information as soon as it becomes available. That's a pretty strong statement. And then they did qualify it. Don't misunderstand the efficient markets idea. It doesn't say that there are no taxes or costs. It doesn't say that there aren't some clever people and some stupid ones. It merely implies that competition in capital markets is very tough. There are no money machine, and security prices reflect the true underlying value of assets. So he's not really qualifying. They're not really qualifying it very much. They're telling you to believe prices you see in the markets as if they were truth. They have subsequently, however, in their 2008 edition, this is after the beginning of the financial crisis, they have qualified it. I don't mean to laugh. They're great people. They're reflecting, when you write a textbook, the ideas of the time. But I'm just using this as a sign of how much thinking has changed. They now say much more research is needed before we have a full understanding of why asset prices sometimes get so out of line with what appears to be their discounted future payoffs. So the efficient markets hypothesis has taken a hit after the financial crisis, and you can see it in the textbooks. That's a problem. So I think efficient markets is like that. It was a scientific revolution that came out really in the 60s and then the 70s. And it led to the extreme bull market that we had around the world in the 1990s. People then finally decided that whatever the stock market does is right. Whatever the housing market does is right because its markets are efficient. And that, unfortunately, wasn't quite right. Harry Roberts is the coiner of the term efficient markets. Although I've traced the history back almost 100 years before him, they didn't call it efficient markets hypothesis. He said there are three forms for market efficiency. Weak form is that information in past prices can't help you to forecast. The semi-strong form of efficient markets is that all publicly information is already incorporated into market prices. And the strong form is that all information, including inside information held by the companies, is already incorporated into stock prices because it leaks out. Companies can't keep secrets. Actually, I think the semi-strong form is the one that we focus on. I don't think that companies can't keep secrets. They sometimes leak out, but they don't always leak out.
So my first question is, so the efficient markets hypothesis was stated 50 years ago, but why is it still a hypothesis? Shouldn't there be enough research and data to either accept or reject it? And even more puzzling, how was the Nobel Prize awarded to someone who clearly advocates this theory, Eugene Fama, and someone who challenges this theory, you, at the same time?
Well, there's a lot of things I have to say about this topic. One of them is even more than 50 years old. They didn't call it the efficient markets hypothesis. But going back centuries, there were people who thought markets are wonderful and perfect. They may not have articulated it as well. The term efficient markets was popularized by Eugene Fama, who won the Nobel Prize with me. I actually am a big admirer of Eugene Fama, and his papers on this were very interesting. I would say that the efficient markets hypothesis is a half-truth. It's sort of true. It's good. I try to teach it to you. I hope I taught it. Maybe I didn't go far enough in extolling it. But it's useful for you to think of that if you want to go into investing, because you probably have exaggerated expectations for what you can do. So, I said that. Eugene Fama would be pleased to hear this. But then I have also a sense that it's not that efficient, it's not that perfect, and that we shouldn't trust it. So someone listening to efficient markets theory might say that the head of a central bank should never comment on the stock market because the stock market itself is smarter than any individual. And now I think, maybe they shouldn't usually comment on it. But there are times when the market looks crazy. And I'm sorry, I think that the Fed or the central bank head is smarter than the market, often at least, not always, and ought to make an opinion on that. And that also that certain anomalies have appeared. For example, buying stocks with low price earnings ratios has paid off historically for a long time. I think that that's probably best explained by psychological theories, that some stocks become ignored and they get underpriced because nobody remembers them. Others get overpriced because they're hot. That's something to keep in mind to understand market fluctuation. So it is a hypothesis. I would say we know, I would say, maybe it's wrong to call it a hypothesis. The better name for it would be the efficient markets half-truth. Now the idea is the price of a stock should be the present discounted value of expected dividends. We'll come back to present discounted values less, but what we have here is that the price is equal to, well, I'm assuming earnings equal dividends. Price equals earnings divided by a discount factor, which is the interest rate, the discount rate, minus the growth rate of earnings. So price equals earnings over some number. This is called the Gordon model. And these are not necessarily exactly today's earnings, but we'll use that as an approximation. So what it implies then is that unless the risk factor is different for some stock than another, making for a different discount rate, the price earnings ratio should be the same in every stock. That's the Gordon model. So efficient markets theory has to explain why some companies are priced higher relative to their earnings than others. And it would have to be, if you believe the Gordon model, it would have to be something about risk or growth opportunities. So if a company is priced high relative to earnings, it would either have to be because it's low risk, as measured by beta, so we're willing to pay more for it because it's low risk, or it would have to be that people have reason to think that the earnings path, the growth rate, G, is high, so that you're dividing by a smaller number. So the efficient markets theory would attribute, it would explain differences in price relative to earnings in terms of either the discount rate or the growth rate of earnings. So that markets are all priced right, even though in some markets the price is high relative to earnings. So if this then gets at some stocks are much more expensive than others. Some sell at a price-earnings ratio of as much as, well, sometimes even more, but let's say 100 times earnings. And you might ask, why would anyone pay 100 times earnings for a stock? Well, efficient markets theory would say, well, in its infinite wisdom, the market has decided either that this stock is very good in terms of risk, or that's R, or that the growth rate of the earnings of this company is going to be phenomenal. So that a high price earnings ratio should predict high growth rates of earnings. So these are ideas. Why do people think markets ought to be efficient? There's the marginal investor story that the smart guys are the ones who trade regularly. They trade fast and immediately, and they dominate trading. There's also a survival of the fittest argument, that some people go to Wall Street who look smart, but you know, they're really not smart.
I see. On the PE ratios, though, do you think then that different industries shouldn't have different PE ratio averages?
Good question. There are historic long-run differences across industries and across countries in price-earnings ratios. A good example is Japan, which, if you go back to the 1980s, had the overall Japanese market had a price-earnings ratio almost as up to 100. People back then were saying, everywhere but Japan, they were saying, this is crazy, what's with those Japanese? That's too high. But if you go to Japan, it seemed different. And I actually did a questionnaire survey comparing US and Japan attitudes toward the Japanese market. And I know this is true. The US people were highly skeptical, but the Japanese were very enthusiastic. So the price earnings ratios did come way down in Japan after that. I think it's because the Japanese, they're human like all, I'm not criticizing the Japanese, but they got kind of carried away with their success and they bid the price up. And that can be a psychological cause for differences, and they can be prolonged differences in price earnings ratios. There could also be other, of course, differences, like differences in accounting standards. Here at Yale, with Glenn Ellison, did a study of smart money, and they judged smartness by the average score you got on your entrance exam, the SAT exam. Not you, they couldn't get it for the individual. They got it for the college they went to. And they found that people who had by inference the higher scores did outperform the others. And I think that's very significant. I hate to say it, but not everyone is equally intelligent. Saturday's newspaper. Someone is doing it again. Is Mr. David Levine. At this point in the market, when 3/4 of you are predicting a crash as of last Friday, he says, how much of your nest egg to put into stocks? All of it. Okay. This sad. I was kind of shocked to see it. Right now, when the market looks so tumultuous, he's telling people, he says Warren Buffett has stated that 90% of your portfolio should be in stocks. I'm wondering, is that recent? When did Buffett say that? But anyway, apparently at some point Buffett said that. He said, Mr. Buffett is too conservative. Okay. So I'll stop with that. What I'm trying to convey is efficient markets theory I say it again, is a half-truth. There are a lot of smart people investing, but a lot of that smartness is devoted to marketing and manipulation of your psychology. And this guy, I don't know, he might be right. In fact, it was kind of a thoughtful article, but the sales pitch I thought was kind of a non sequitur. If you read the whole article, why is he so confidently telling you to put everything in the stock market? It's just a gut feeling. Ultimately, these gut, and maybe he's well-meaning of the whole thing. I'm not trying to disparage people's ethic. I'm saying it may be well-meaning, but the kind of things that get heard are things like this, and they tend to drive market.
I guess back to the efficient markets hypothesis, do you think that like large stock market crashes like that in 1987 or in like 2008 disprove or prove the efficient markets hypothesis? Is this like prices catching up with information or information catching up with prices?
Yeah.
And how does that?
Well, one problem, if you look at 1987 or 2000 or 2007, there's only a handful of examples. And to disprove a hypothesis, you need a lot of data. But on the other hand, people who lived through these crises have often reported that their faith in the markets was diminished by the experience. And I think that maybe what they're referring to is how it was reading the news every day about these events and talking to people about them. I think the experience of living through a crash makes it obvious that human emotions play a role, and that people were buying and selling who didn't know what was happening. And so I think that it's often a human judgment thing. Having experienced an event like this makes it seem, it's kind of crazy to think these markets are perfect. I haven't met anyone yet who is behaving in a completely rational way. How could the combined effect of all their buying and selling be completely rational?
But actually, going back to Eugene Fama, when he was asked about the 2008 crisis, he said that the market behaved really well because prices started to fall in advance of when people accepted there was a recession. So the prices were already incorporating the recession. So how do you respond to that?
So the stock market has been documented. This is known for almost 100 years as a leading indicator. The stock market has a tendency to fall before a recession. So what do we take of that? Well, there's two possible explanations. You could say that the market is smarter than everyone else, and it's like a fortune teller, and it sees the future. But there's another explanation. You could say that, what are you thinking?
Does it cause?
It causes the recession. So the market goes down, and people say, something's wrong, It's just like if you take your temperature and you find it's low or high, you suddenly think, maybe I'm sick. And you say, maybe I feel a little sick. And when you do that with masses of people, it can have that reverse causality.
But in 2008, you can also say that the stock market crashed due to like an underlying problem in the housing market. And so were the prices that the stock market was crashing actually a reflection of like new information that the market provided? So is that maybe proving the efficient markets hypothesis in that case?
Well, this is something I've been involved in debating for many years. And there's different approaches to answering your question. But one is to say, how big, in any one of these crashes, how big was the loss to the economy because of the recession? And was the market acting appropriately to that? So, for example, in 1929, we had the beginning of a stock market crash that bottomed out in 1932, and the market lost over 80% of its real value. So, wow, that's a big drop, 80%. But then people say, well, but we had the Great Depression after that. Maybe we did. In fact, we did have the Great Depression. But you know what? The Great Depression wasn't that bad. It wasn't anything like an 80% drop in GDP. It was temporary, you got over it. People like to tell stories, and they can tell a story that justifies the market as forecasting amazingly. But to me, it's just a story. I've been very much involved with this field since around the late 1980s, joining psychology and finance. and it's a deep belief of mine that it really matters. So I'm trying not to overemphasize this in this course, because this is a general course in finance, and I don't want to overemphasize one aspect of it. On the other hand, it sounds to me extremely relevant. Maybe I'm influenced by the fact that my wife is a psychologist, but I don't think it's just that. I think there's a problem in academia that departments are too separated. They don't go to each other's, professors don't go to each other's seminars and get to know other fields as well as they ought to. Though there's so many topics in behavioral. Oh, by the way, it's a revolution. I don't know if I said this before. The first one we just talked about was the efficient markets revolution. It came in with also the capital asset pricing model and mathematical finance. That was an important revolution. I'm not saying they were wrong. Everything is half-truth in life, isn't that true? No simple model will explain everything. But the next one was behavioral finance, or more broadly, behavioral economics. And that came in around, well, it's fuzzy, but around 1990. Well, I think the term behavioral economics appeared then, and it became a sort of revolution. But the ideas go back very far. And they go back, in fact, to the father of economics, Adam Smith. Now, you know Adam Smith for his book, The Wealth of Nations, which he wrote in 1776, which describes free market economics and is interpreted widely to be a libertarian or free market tract. Adam Smith was a champion of letting prices go where they may because they allocate scarce resources. I don't think he used that term exactly, but had that meaning. He's famous for the quote, invisible hand, that the free market is the invisible hand that's directing the economy. And he said that, who makes sure that enough coal is being dug out of the ground for next winter? Is there a government department of coal production? Well, there isn't now, and there wasn't in 1776. So what determines it? Well, it's the profit motive. This is Adam Smith in his famous book, The Wealth of Nations. And prices guide it. If price gets high, the coal mines will produce more because it's profitable for them to do that. And so the price equilibrates at a level that is just right for the upcoming winter when people have to heat their homes. There will be enough coal. But the other side of Adam Smith is in this other book called The Theory of Moral Sentiments. He said that he's not any academic psychologist. He's just writing as a public intellectual in 1759. He said that he has noticed throughout life that people really like to be praised. Now, I guess that's obvious, right? You notice this in young children. You tell them you did something good, they seem to respond, and it goes throughout life. But then Adam Smith points out, are you happy with being praised for something that you didn't do? Suppose somebody makes a mistake and thought that some achievement was yours, but in fact it's just a mistake. He's not going to. Now, and suppose you also know that the mistake will never be revealed, so you've got this on your resume, some great achievement. Do you get pleasure from being praised for this? And he said, probably not, right? It just doesn't. You want to be praised for something you really did. And so he said, especially as one gets more mature and thinks more about life, as people mature, the desire for praise morphs into a desire for praiseworthiness. So people want to be suitable for praise, even if nobody knows it. So he gives the example of mathematicians. Mathematicians are not famous, usually. That's because the public can't see or understand what they do. In contrast, even in 1759, actors and singers were famous, were wildly famous compared to mathematicians. So why don't mathematicians despair? Nobody knows who I am. I'm doing all this work. It is because they have a small community of mathematicians who've read your work and respect it. And you know that you are praiseworthy for this work, even if you're totally unknown. So that's what he said. And I think there's some real insight that he has. This is really true, at least for mature adults, that you develop a sense of your own praiseworthiness. So that's very different from the usual assumption in economics that one wants to maximize consumption. So let me start with more modern behavioral economics and talk about prospect theory. So the term prospect theory was coined by psychologists Daniel Kahneman and Amos Tversky in an economic journal, Econometrica, 1979. A very important paper, and in fact, at least as of some years ago, the most cited paper ever published in Econometrica, which is the top journal for mathematical economists. What they are criticizing is the core theory of economics, and they're replacing it with a constructive alternative. The core theory being expected utility theory. So the economic profession tends to use the idea that everyone has a utility function which depends on the things that they consume, and it represents their happiness. You've heard of indifference curves? Those are contours of the utility function. And that people in a world with no uncertainty will choose how much to buy at the market prices to maximize their utility function. And then if there's uncertainty, then people use the probabilities of possible events to calculate the expected utility, and they maximize expected utility. Kahneman and Tversky changed two things in expected utility theory. One, they replaced the utility function with what they called a value function. And two, they replaced the probabilities with subjective probabilities determined by a weighting function in terms of the actual probabilities. So this, let me talk about these two elements here. The first thing is the value function. That's a plot from their 1979 paper of what the value function might look like. This is based on their experiments, but this is just a hand-drawn story. Now the utility function, if you think of from elementary economics, the utility function exhibits diminishing marginal utility everywhere. And it's concave down, right? So a utility, the upper right segment of their curve looks like a utility function. You see it's concave down and it's growing. The axes, okay, the horizontal axis is the amount of money gained or lost, and the vertical axis is their counterpart, their replacement for utility, which they call value. But if you look at it, there's a funny kink here at the origin, and then they have it concave upward, not downward, for losses. The other thing is, I should emphasize, the utility function is not usually put in this term between gains and losses in economics. Your utility is determined by how much you have, and it doesn't make a distinction. It doesn't focus on what you have now. What they're talking about here is how you react to an opportunity on any given day. And what they said is that on any given day, you form a reference point for today, and that's this reference point, okay? And the utility depends on relative to your reference point, what your gains and losses might be. There's a kink at the reference point, okay, which means that there's something special going on. But this reference point is kind of arbitrary. It's just where you see yourself today. That is, now I'm not going to get into details of this, but this is the idea which they proposed instead of utility based on experimental evidence. So let me talk about evidence quickly through this. The kink, the first thing is that the origin moves through time. You're not consistent through time. If I get more money, then I move my reference point up to more money for the next choice that I make. And if I have less money, I'll move it back. That doesn't happen with utility. What they're saying is that it's subjective. I'm thinking always relative to where I am now. So for example, there's a kink in the slope. You see the slope is high here and then it becomes low at a point, which is today's reference point. So what it means is that people, one implication of this is people will not take small bets. So I'll give you an example. The famous example occurred at lunch at MIT about a half century ago. And Professor Paul Samuelson, who was a famous professor, was seated with E. Cary Brown, another professor, not so famous. And Samuelson said, on the spur of the moment at lunch, hey, let's try a little gamble here. Let's flip a coin, and if it comes up heads, I will pay you $200. But if it comes up tails, you pay me $100. So he proposed. You see he's being very generous here because he's giving the other guy $200 as against $100. What's the expected value of that bet? Well, it's 0.5, assuming it's a fair coin with the probability of coming up heads. 0.5 times 200 minus 0.5 times 100. So that's $50. So Samuelson thought he would immediately take it. But E. Cary Brown said, no, I don't, what are you talking about? I don't want to do that. And he didn't want to do it. And Samuelson said, are you sure? I mean, I gave you a positive expected value bet. It's only a couple $100, right? Well, that sounded like a lot. Back then it was worth more than it is now. It sounded like a lot of money. But he just didn't want to do it. So Samuelson then said to E. Cary Brown, okay, how about doing it 100 times? Well, I'll do this. This is hypothetical. I'm not really offering this. But if I offered to do it 100 times in a row, would you do it? And then E. Cary Brown said, gee, I mean, by the law of large numbers, I'm going to make something like $5,000 practically for sure. So E. Cary Brown said, okay, I would do that. So then Samuelson went back to his office and wrote out a mathematical proof that E. Cary Brown is irrational. Because if you would take 100 of them, you should take one of them, right? But E. Cary Brown was just behaving the way this value function. The kink at the value function means the gains look so much smaller than the loss. So psychologically, so I don't want that. But if it's 100 of them, then it's just moving him up here for sure. So of course he'll do it. But see, there's a fundamental human error here that we focus on little things and we panic at little bets. You should be doing, I don't know if you're ready for this. If I actually offered, I should have asked for a show of hands. If I offered you a coin toss like that, you'd take it, right? I assume, at least if you learn anything from this course about rationality, you should do it. Anytime you get a bet like, it's a small bet, you should, with a positive expected value, expected utility theory says you take it because there's not much concavity to the utility function, but people don't. The other thing is that this thing curves up for losses, and what that refers to is there's risk preference for losses. People, it's a little bit hard to explain, but what the key idea is that people are willing to take big risks to escape losses. So for example, someone at a gambling casino who's lost a lot of money and now is in the reign of losses starts to think maybe of taking a really big bet that might have the possibility of bringing them away so they could close the day up instead of down. So that people have a tendency to take risks in the domain of losses to try to get them back. So that's the value function. The other thing is the weighting function. Now on this axis we have the stated probability. Now probabilities range from 0 to 1. And so that's the actual probability of an event. But on this axis we have the decision weight, which is a psychologically transformed probability. And you can see that the curve, this is the 45-degree line. If people were completely rational, they would use the actual probabilities in their calculations. But they do not actually behave completely like that. They tend to transform their weighting function so it looks like a curve with a slope less than 1. Also, it doesn't show, for very low probabilities and very high probabilities, the line stops. You notice that it doesn't tell you. Or by some versions it drops to the 0, or it jumps up to 1. So what they're referring to, let's talk about the fact that it doesn't go to 0 or 1. What it means is, for very low probabilities, you have a tendency to not appreciate them and actually often to drop them to 0. I'm not going to think about that. If it's a probability of 10% of happening, you might worry about it. But if it's 1%, I'm going to round that to 0 and not worry about it. Similarly, on the upper end, if something has a very high probability, people don't accept that they don't take that probability into account, and they round it to 1. So I'll give you an example of the application of the weighting function, and that is it used to be that when you board an airplane, they had vending machines that offered you insurance against dying on this flight. It's one flight, and they would charge you like $1 for an insurance policy. And they would put the machine right there where you're boarding the airplane. A lot of people would buy this because they're boarding an airplane and they just get a little scared about this flight. Well, actually, the probability of this flight crashing, what is it? One flight? It's 1 in 10 million, right? So that $1 insurance should give you a coverage of $10 million, but it doesn't. It gives you something very remote from that. And people still buy it. Why do they buy it? It's because they're nervous. You hear about all these plane crashes. You think this could be my last day on Earth. I feel like I want to have done something. But in effect, you see the probability is exaggerated. So for most people didn't buy it. So those are the people who were down here. They rounded it to 0. But some people are right there. There's a little bit of fluidity in this theory. And you either exaggerate it or you ignore it. And so there's a whole business exploiting people who exaggerate it. Also, the curve has a slope less than 1. You could caricature this by saying there's 3 possible weighting values: 0, a half, or 1. And so emotionally, I can't process these numbers. That would be the case if this curve were actually flat through a half. But it's not absolutely flat. But it is true that in this realm, people don't take full account of the differences in probabilities of events. They tend to blur them a little bit. So that's prospect theory. People are overly focused on little losses, little gains and losses. I can get you worrying about a $2 plus or minus $2 loss. I can get you overly concerned by that. You should not worry about plus or minus $2. That's nothing. But people do worry about it. You should be worrying about the big things. And that's one mistake that Kahneman and Tversky put in their prospect theory. Another thing is that people will often try to gamble out of losses. If you went to the casino and you lost money, you think, maybe I should gamble some more. Maybe I can get back to where I was. That only makes things worse. But that's what people do. That's also part of prospect theory. So what I think prospect theory is a experimentally based set of knowledge about mistakes that people make. And I think it's good to learn about prospect theory to help yourself from making those mistakes.
So it sounds like there's a large intersection between social psychology and finance that we've been talking about in class. And this is a bit more abstract, but in terms of the chicken and the egg, what do you think comes first? Do you think that people have biases which are then reflected onto the market and make changes, or do you think that the market is currently structured in a way that confuses the average investor?
Well, you said which comes first. I know chronologically there were two important revolutions in finance over the last half century or so. First was the efficient markets mathematical finance revolution. The second one was, that started in the 50s, 1950s, maybe. It's hard to define exactly when it started, but let's say the 50s. And then there was the behavioral finance revolution, which brought psychology in. So I think these two revolutions are kind of incompatible views of the world, but they both offer insights. They're both exciting. And so which one comes first? I don't know. I think that it's just a matter of models that you have in any science are models that abstract from certain details and offer you insights into what is happening. But then if you are an engineer trying to design, I'm thinking of physics and engineering, an engineer has to have a different way of thinking than a physicist does. He has to say, I want to know all the frictions, all the problems. What if someone tries to use my device in freezing weather? Will it still work? Things like that. So we have to really, financial engineering is an important field these days. Not using that term disparagingly. Sometimes people use the word financial engineering to describe manipulative practices. I don't mean it that way. I mean in terms of innovation. Financial engineering takes a somewhat different personality than financial theory. Financial theorists like to develop beautiful models, but a financial engineer wants a beautiful device that works in various conditions with real people. And so that requires, I think, like engineers will tell you, you can't rely on any one physical model. You have to realize that the world is complicated and funny things happen to machines and they jam up or something goes wrong. Same with financial machines.
Professor, I was wondering if we could go over some of the key features of prospect theory at a very high level and just kind of talk about what features it has as well as how it might be different from more traditional approaches.
Well, prospect theory is written by two psychologists, not economists, Daniel Kahneman and Amos Tversky, over 30 years ago, overturning, a key assumption of much economics that represents people as rational and calculating in a sensible way. So what Kahneman and Tversky said is that people, maybe that's a little bit rational, but it looks a little screwy what people do, actually. And what they did is a number of experiments that show about decisions under uncertainty that show funny behavior of individuals. How to present the thing that it takes off from is the economist's idea that people are maximizers. You know, we're all calculating, we're all out there figuring out. Now, to some extent, we are. But what is it that we maximize? So economists say utility. And then they also have to recognize that utility is happiness or something like that. But they also recognize that you don't know the outcome before you make your decision. So it's random. So we have to say expected utility. This is traditional economists. I know what I want, and I'm very consistent in pursuing that under uncertainty. But Kahneman and Tversky said, well, you know, people don't always do that. Let's talk about flipping a coin.
Sure.
I'm going to propose to you, let's toss a coin. If it comes up heads, I will pay you $200. If it comes up tails, you pay me $100. You want to do it?
Yeah, I'm a little hesitant.
Yeah. But it's a positive expected value because it's
Right.
equally likely, the two outcomes. And one of them, I pay you $200,
Right.
but you only pay me $100 if it goes the other way.
Right.
So you have an expected gain of $50. So, yeah, you said you're a little hesitant.
Since I'm a grad student,
You're not going to say no because you know what the right answer, the rational answer is.
Right.
The rational answer from expected utility theory is, of course I'll take it, because it has positive expected value. I will take lots of those bets, and they'll all average out to a gain. And so you should take it, unless there's something very unusual about your utility. So what Kahneman and Tversky said is that people have a value function. So I'll draw a curve here. It won't be a curve. This is gains on this axis, and this is they call it value, but it's happiness or utility. And it's the curve is kinked like this. All right. This is where we are now.
Right.
The reference point. This is for you.
Right.
Plus 200. And this is for you minus. This is minus 100. Right? So you're looking at your happiness. Well, you're thinking, well, plus 200 only gives me a little happiness, this amount.
Yeah.
But losing 100 gives me a lot of unhappiness. So you won't do it. This kink here represents, this is where we are now.
Right.
In prospect theory, there's always a kink where you are now. Now, you could make $10,000 more in your work, let's say, and it push you way over here.
Right.
The kink moves with you. It's always there. So at any point of time, you're always worrying about losses.
Okay. Relative to where you are now.
But yes, relative to where you are now. But this is irrational, because you should, anytime anyone offers this bet to you, you should always take it. And you know, if you do it many times, you'll come out ahead on average. But people don't. That represents an irrational behavior that Kahneman and Tversky called loss aversion. We worry so much about losing money. We don't have the idea that, on average, I'll do fine. I just don't. But you don't feel that way. Anytime that you make a loss, you kick yourself and you feel bad. So you don't want to take that chance.
I see.
And that's an irrational behavior. And it's demonstrated that people behave this way.
Okay. And so, just to reiterate, it's this steep curve that is kind of what is the key to all this. It's
Right.
that kink that you said follows you around.
Yeah,
every
follows
year.
you.
Okay.
You're always worried about little losses today. The second thing is overconfidence. And psychologists, well, you can just do a survey. Most people think they're above average. Most people think they're a better driver than the average person. Most people think if they tried hard, they would be a better investor than the average person. Most people think they understand some things that are not widely understood. Wishful thinking bias is actually a term used in the psych literature that people overestimate the probability of things that they identify with and want to see happen. Very simple. You ask people what they think the probability of their team winning is, and it's always higher if it's their team or if a political candidate. So this wishful thinking bias also helps explain the immense volume of trade in financial markets. There's so many shares traded every day that it seems a puzzle. Why would people need to change their holdings so often? Well, it must be because of wishful thinking bias. There's also a tendency for overconfidence in friends and leaders. Well, I say here the central bankers tend to be thought to be a genius throughout history. They're always geniuses until they mess up, maybe. But there's also overconfidence in your own friends. You tend to think that your own friends are really smarter than average. It's not just you. Anyone you identify with, you tend to be overconfident in. So there was a book by Rakesh Khurana at the Harvard Business School that documents the way CEOs, chief executive officers, are chosen by corporations. Now companies will bring in a CEO from another company that was a success to transform their own company and pass over someone in their own company who knows the business really well and has been there 30 years and might well be promoted up to CEO. But they'll take in someone from another company that was a success there without regard for the fact that it was probably mainly luck that this person was a success. And they'll put him in place of their own guy, and then he feels that he has to make some transformation. He's supposed to be a genius. They're paying him $50 million. So he does some dramatic things and totally destroys the company because he doesn't know what he's talking about. Also, Nassim Taleb, in his book Fooled by Randomness, which is another great book to read, describes how people in business are overly influenced by the random successes of themselves or others. People are over. Now, Irving Fisher was a professor here at Yale, and he wrote a book. He was writing a book in 1929 about how the stock market will continue to make us richer and richer, but the crash interrupted his book, so he had to change the title of the book. So he called it The Stock Market Crash and After. But what he said is the stock market crash of 1929 is a terrific buying opportunity. I was right all along. The stock market will just keep going up, or at least stay at a, quote, permanently high plateau. He ultimately borrowed money to try to stay in the market. He borrowed money from his relatives. He lost everything. He lost his house. He had no place to live. His house is right near here on Prospect Street. They tore it down. It's gone. Yale had to give him a place to live, but he never gave up. He kept saying that the stock market will keep going up. Why do people do this? Well, this is overconfidence. I mean, he's a great speaker, but he wasn't a great stock market forecaster. Cognitive dissonance, this is a term used by social psychologists. It refers to the mental conflict that occurs when one's beliefs are discovered to be wrong. So I'll give you a famous experiment that revealed cognitive dissonance. The experimenters went to get a list from car dealers of people who had just bought a new car. They knew that the person had bought a new car, and they knew what model it was. They then didn't tell the subjects how they had found them. And they asked them, what magazines do you read? And when they named the magazine, they would pull out a copy. They had all the new magazines there and say, let's go through the magazine, and you tell me which ads you read in the magazine, and also whether you thought about them and read them carefully. So what do you think people did? Did they read ads for the car they just bought? Yes, they did that strongly. They read and reread and congratulated themselves about how great a car it was. Do you think they read the ads of a car a different make of car that they were thinking of buying but did not buy? Well, as you expect, no, they don't read those ads. So why are they isn't this irrational behavior? You've already bought the car. Why bother to read any ads? But on the other hand, why would you selectively ignore the ads for the other cars? Well, you're just trying to make yourself feel good, right? And so it's irrational behavior. Once you've made a decision, you kind of identify with that decision, and it's me. Now I want to hear more about why I was right. I don't want to hear that I might be wrong. It's a personal thing. This isn't really talking about being embarrassed by a bad decision. It's just perfectly internal to you, that you just get a bad feeling when you made a mistake. So the disposition effect might also be partially explained by that. If you bought a stock and its price goes down, you're feeling that maybe you were wrong, and that gives you a cognitive dissonance. So you just avoid it. I'm not going to think about that stock. I didn't buy that. I'm not here. And then until it goes up, if it goes back up, then you might sell it as soon as it comes back. So Will Getzman here at Yale with Nadav Pellis looked at mutual fund investors. These tend to be small retail investors. They found evidence for cognitive dissonance, basically the disposition effect. But they also found that when they talked to investors, they didn't even remember the performance of funds that had declined. So there's a tendency of human thought, because of cognitive dissonance, just to blank out your bad memories of times when you were wrong and don't even know that they happened. We live in an economy that incentivizes people to capitalize on your psychological quirks. And they strongly incentivize people to do that. That's what the profit motive is all about.
So do you think that we're not rational with these quirks, or would you agree that
well,
most people are rational?
We're not rational. I'm not rational. I don't know about you. We're not rational in the sense that we have some consistent, logical way of deciding things. We all make little mistakes. And we learn, by the way, we hear from others about when they were really taken advantage of, so we avoid some things, some gimmicks. And we have laws against them. You know, the government regulates lotteries. You can't start a lottery. You can't do it at all. Or maybe you could do it as a part of a state government. And that's because they know that there are lots of giveaway contests, but they don't charge because it's illegal to charge for them. They can just use them as publicity. So we have a legal system that protects us against our own psychological failings. Fourth is mental compartments. Hirsch Sheffrin and Richard Thaler said that people, these are economists now, talking about investors, that people don't look at the whole portfolio the way the capital asset pricing model assumes. The theory says that you should care about what your whole portfolio does, what's its expected return, and what's its variance. But that's not the way people think. In fact, Sheffrin and Statman said that people have two portfolios often, or maybe even more than two mental compartments. Let's just talk about two. You have a safe part of your portfolio that you will not risk, and you have a risky part that you can have fun with. In fact, some people even said, I talked to my spouse, and we agreed that I can have fun investing for 20% of our portfolio. But again, see, that's totally at variance with. And then at cocktail parties, he or she will boast about how the fund portfolio did, rather than talk about they don't talk about the overall thing. That's boring. So option salesmen try to get you to buy a put on a single stock, and they will advertise it to you in such a way that does not make any reference to the impact this will have on your whole portfolio, which is probably minuscule. They don't think that way. Fifth is attention anomalies, and that is that we tend not to pay attention. Well, first of all, psychologists have long understood that you can't pay attention to everything. You have to decide, am I going to pay attention to the stock market? Should I watch it every day? Or is it a waste of my time? Should I be watching other things? So the problem is that too many people watch the stock market every day. And if the market moves a lot, then they will even pay more attention to it, even though a day-to-day move is irrelevant generally. There's a social basis for attention, and that is that you tend to pay attention to the same things that other people pay attention. Now, this social basis for attention may have evolved for good reason. So, for example, in a primitive caveman society, if somebody else is looking, what's that over there? You'll look too, and so will everybody. Maybe it's a wolf coming to attack, or who knows what it is. So we have that tendency to pay attention to everyone else at the same time. But what that means is there's going to be mispricings in markets. If everyone is paying attention to some stock, it creates the probability that it will be overpriced. Now, in finance, we tend to talk about the no arbitrage assumption. That is, that there's no way to make money without risk. No $10 bills lying around on the sidewalk. That works counter to this is a theory that is not so vulnerable to attention anomalies. Have you ever found a $10 bill lying on the sidewalk? Probably not, right? Maybe you have once in your life. Doesn't happen very often. That's because somebody will pick it up before you got to it. We do have an ability to pay attention to independently of others. So $10 bills get picked up. That means there's no sure money machine. But when it comes to more ambiguous investing, then we become vulnerable to the attention anomalies. So some stocks get overpriced and others are just forgotten. They're underpriced because people aren't thinking about them. Anchoring refers to a tendency in ambiguous situations to allow one's decisions to be affected by some anchor. So the famous experiment that Kahneman and Tversky did involved a device called a Wheel of Fortune, which you might see on quiz shows. So what they did is they had a wheel with the numbers, well, maybe 1 to 100 on the wheel. And the guy would spin the wheel, and it would stop randomly on some number between 1 and 100. So this is their experiment. They asked them questions that had numerical answers between 1 and 100. So one of the questions was, what % of African nations belong to the United Nations? Okay? Most people haven't thought about that. Then they spin the wheel, but they said, before you answer, I'm just going to spin this wheel, ignore it. But they spin the wheel, and it comes up with a number between 1 and 100. And then, okay, now I want to hear the answer to your question. People tended to give a number close to the one that just came up on the wheel. Amazing. So then, after the experiment, they pointed it out after the experiment was over. They said, did you know that you tended to pick a number close to the wheel? And they would say, no, I didn't. I wouldn't pay attention to that. It was subconscious. They were influenced by it. That's anchoring. So it's the same way, I think, with stock prices, that stock prices are anchored to past values. Nobody knows what this company is worth, but it was worth something yesterday, and so our opinions tend to be influenced by anchoring, just as they were in the Kahneman and Tversky experiment. So companies know that stock prices are anchored to past values. They also like to do splits, where if a stock reaches $60 a share, they'll split it so that it becomes $30 a share, just because that seems to be a good, solid anchor. I formed a company with my student here at Yale, Alan Weiss, Case Shiller Weiss Incorporated, in 1991. And shortly after, in the late 1990s, we were trying to raise money for our company. And we went to an investment bank that heard us out. And he said, well, maybe we can come up with money for your business, but could you consider changing the name of your company? I don't want it to be CSW Inc. We want it to be CSW.com. Now, if you know, this is the dot-com bubble days in the late 1990s. So we had a meeting at our company. Should we change the name? We had a website in the late 90s, so we could call ourselves .com. We were selling on the web, but we didn't do it. That was fake. That was trying to anchor us to the .com stocks. But you know, there was a horrible .com bubble at the end of the 1990s. People would pay anything for a .com company. So it just didn't make a lot of sense. 7 is the representativeness heuristic. People judge things by familiarity to familiar types. So there was a famous example illustrating the representativeness heuristic. This is Kahneman and Tversky again. They described people in terms of their characteristic and then asked you to guess their occupations. For one of the persons, for example, they describe a woman and said that she's sensitive, artistic, okay? And then you're asked then, what would you just guess her occupation is? And the choices involve bank teller or sculptress. Well, people tended to pick sculptress rather than bank tellers. Now, Kahneman and Tversky said that's totally wrong, because there are so many more bank tellers than there are sculptresses. So it's not a rational choice. But they looked to see the best fit rather than what is statistically probable. So, for example, 1929 stock market crash is still widely remembered. I don't know how well it is remembered for your generation, but you've heard of it, right? So you tend to look to see, is it 1929 again? And if it fits 1929, you'll exaggerate the probability that we're facing 1929 again. The disjunction effect is the inability to make decisions in advance, in anticipation of future information. So, for example, Shafir and Tversky actually did experiments with Samuelson's lunch colleague bet. But then they did a variation of the experiment. They asked people to decide in advance whether they'll take the second bet. And then most would not take the second bet before they knew the outcome of the first bet. What I'm saying is people couldn't understand how they will feel later. They don't anticipate their emotions later. So they can't work through a decision tree correctly.
So with these biases people have, do you think there's any way to try to mitigate them, or do you think it's better to try to accommodate them when we think about planning for our financial futures?
Well, one thing that we can do is financial education, and that is important. Many people, there have been studies of the level of knowledge among the general population of financial basics, and the general conclusion is it is extremely low. For example, it's pointed out that people don't understand compound interest. But it goes even beyond that. They don't even understand interest. A lot of people, maybe a minority, A lot of people, if you say, if the interest rate is 2% and there's no compounding, how much do you have after 5 years? They can't answer that. They'll say 2%. So I mean, I don't mean to be disparaging of these people, but there is a definite need for financial education. We also have to try to get a standard for presentation of facts about investments to people that are done in a way that's not exploitive or manipulated. And we already have a lot of, they go back a long time, rules about how advertising can work for financial products. It's a difficult situation, but hey, we have a lot of young professionals who can work as regulators. And it's not just government regulation, it's also self-regulation within the industry. Things like better business bureaus and chambers of commerce that impose a higher standard on business. 9 is magical thinking. This is a term invented by B.F. Skinner in 1948, describing not human beings, but pigeons. The very simple experiment. You had pigeons in cages, and they had a mechanical feeder. These were hungry pigeons. They kept them, they weren't getting enough food. Maybe this is a cruel experiment. Not that cruel. They were just hungry, like on a diet. And they had a mechanical feeder that would drop 1 pellet of food every 15 seconds into the cage. This was really annoying to the pigeon because it was hungry and it had to eat at such a slow pace. But what he found was the pigeons started doing bizarre things, dancing around or stomping their feet. And he wondered what it was, so he watched more closely, and he discovered that they did the same thing that they did before the last pellet. They noticed that they stomped their foot randomly, and then a pellet came out. And so they thought, well, maybe that caused the pellet to come out, and they tried it again. And since it was only 15 seconds between pellets, one came out, of course. Then they thought they'd learned that it affects the pellets, even though it had not. We know by construction that the machine was just passing out a pellet every 15 seconds. But the pigeons started repeating behaviors because they thought they were connected to the pigeon. So in effect, they developed superstitions. Then there's something else called quasi-magical thinking. And in this case, we had this relates to Newcomb's paradox. So let me tell you about Newcomb's paradox. The simplest way is to say, people vote, don't they? Why do they vote? Okay? Well, you know that in reality, the probability that the decision will be won by one vote in the election is minuscule, right? There's millions of people voting. The only way that it will make any difference to the outcome is if it's almost exactly tied and you went in and broke the tie. But you know that that's a 1 in 100 million chance. So you shouldn't vote because you're not going to have any impact. But people do vote. And that's a paradox. What do people think when they vote? Well, what they'll often say, if you ask someone, don't you know that the probability that you'll decide the election is 0, 0, 0, 0? So why do it? People will say, well, I know, but I'm a good citizen, and if everybody thought that way, we wouldn't have a functioning system. But Newcomb thought, well, there's a fallacy here. You're not going to affect, by your decision, whether you vote, you're not going to affect what everybody else does. Shafir and Tversky demonstrated this in the lab, in which they had, the subject was playing a game with a computer and is told that the computer had observed the subject's behavior. And they said, we have this really neat program that can predict what you're going to do in your next decision. The computer knows what you're going to do. So he's told that the computer, there will be 2 boxes that appear on the screen, box A and box B. Now you're told that the computer has been programmed to put $1,000 in box A, and you're going to give a choice between A or B or both. But the computer knows which people will pick both. If it thinks the subject will pick box B alone, it will put $1 million in box B. Needless to say, this wasn't done with real money. This is a hypothetical. But they asked people, which would you pick, A or B or both? What do you think happened? Well, a lot of people picked B only, because I don't care about that $100. I'll get the $1 million. But wait a minute, the computer has already, they were told, the computer has already decided the answer. So why would you take B? You should take A too, because it's already there. What you decide now can't possibly affect what the computer did in the past. But people do that. So that's a sort of magical thinking. Ellen Langer, who's a professor of psychology at Harvard, found out that people will bet more on a coin not yet tossed. So one option is to say, let's flip the coin, it falls, we don't look at it, we cover it up. Now, you want to make a bet that it comes up heads. People will bet more if it's not yet tossed, as if they think that they can somehow influence the toss by psychic powers.
Do you think there's some point where the average market participant, the average investor, should avoid trying to make their own decisions about financial markets and should rely on expertise? Or do you think that it's imperative that everyone really achieve the level to where they can take control of their own financial future?
Well, I think a medical analogy might be appropriate here. I think people are getting better at managing their illnesses by reading up, learning on the internet or various publications. They don't rely just on their doctor. They're getting better at recognizing symptoms that might be dangerous, and they'll go to the doctor and talk about that. But they shouldn't try to treat themselves. Not generally. They should go to a doctor. I think it's similar with finance. I think that it should be similar, but I think that people don't respect financial advice as much as they do medical advice. Partly that is warranted, I think. I think that medical doctors, my impression, I can't prove this, medical doctors take an oath of loyalty to their patients in medical school, and I think that colors their thinking. They're more idealistic about. They're doing it because they want to help you. Not always. I mean, they're profit-oriented too. But I think that there are some opportunities for financial advisors to strengthen their commitment to their clients. And I think that government policy could strengthen it further too. So, for example, I have advocated that the government should give a tax break for fees spent on financial advice if the financial advisor signs a statement of loyalty to the client, and that the advisor will not steer the client toward financial products that profit the advisor. That will help, I think. Then I think we can develop a better sense of loyalty to the client. And I would like to see a world where there is more respect for financial advisors, more talk about, you talk to your neighbor and say, do you know a good financial advisor? You develop a relation with your advisor. So you're up late at night arguing with your spouse about finances, and you say, let's call our advisor. That would be a good idea, but not many people do that. Not people of modest means, at least, or middle class people. They don't do that very much. So I think we want to move toward a world where there is more financial advice, and that it's more focused on the real needs of clients. Now, culture I talked about earlier, and social contagion. But there's so much to say about this, but culture is our society's values and norms. Social cognition is our thinking in generally. And Emil Durkheim in 1897 was a pioneer in in sociology. So we have actually the word collective memory was used by Durkheim. We remember the same thing. We all have the same facts and statistics in our minds, so we reach similar decisions. There's social contagion, and there's a tendency for us to adopt beliefs of other people. There's a mathematical theory of disease epidemics that can be applied to speculative behavior. So I've assigned for this lecture of the course some pages from the book Irrational Exuberance that I wrote. We talk about moral anchors for the market in the form of stories. There's a whole branch of psychology called narrative psychology, which reminds people that the human mind is influenced fundamentally by stories about people, that we derive motivation from these stories. Robert Abelson at Yale was involved with that too. We have identity, a sense of identity and ego involvement with stories that we think relate to our life. We have a story of our life, and this story can be tied in with other events that help promote one's sense of ego. And finally, my last of my categories is antisocial personality disorder. This is a disorder which has been recognized by psychiatrists. It has been called sociopathy or sociopaths or psychopaths. And so the American Psychological Association publishes a diagnostic and statistical manual. From their 5th edition, we define this disorder in the following terms: identity, egocentric, self-esteem from personal gain, self-direction, absence of pro-social internal standards, lack of empathy, incapacity for intimacy, manipulative, deceitful, callous, hostile, irresponsible, impulsive, risk-taking. Boy, those are a lot of insults. But what they're referring to in the DSM-5 is that this is a pattern, that there are people who show all of these things. There's something in their brain that is different. And so certain emotions which we take for granted are not there. Now in DSM-5 as opposed to DSM-4, it used to be all or nothing diagnosis. Now they want to acknowledge gradations or levels of, it's not all or nothing. We might all be antisocial at some times, but not at others. There's also, this is different from borderline personality disorder, which is more common among women than men. About 3% of men are antisocial personality disorder, at least according to the 4th edition, and only 1% of women. But women, it's reversed with borderline personality disorder. So instability of relationships, extremes of over-idealization, and then devaluation. They swing from thinking this is a perfect friend to not for depressed moods lasting hours to days, inappropriate, intense anger, frantic efforts to avoid real or imagined abandonment. But I want to talk about antisocial personality disorder. The movie, The Big Short, suggests that some people in the finance profession have antisocial personality disorder. Is that true? Well, there's a literature on this. I think the answer is no. Those guys are in jail. That the profession, like the finance profession, like other professions, is pretty successful in discovering these disorders, and people don't get. But on the other hand, there might be an attraction. If you read the list of symptoms of antisocial personality disorder, it does fit. But I think that it's not true. That, like in any other profession, we're successful, and you can't hide these things for too long, and you'll end up caught. It's unfortunate. We have to deal with these. It's 3% of our male population has this disorder. We have to live with it. Anyway, I'm just going to conclude with these psychological principles that I talked about are involved in many things that happen in the financial world.